The combination of an Iran-driven oil shock and a sudden surge in employment has forced a total recalibration of the 2026 macro outlook. The primary catalyst was the June 5th market liquidation. The U.S. added 172,000 jobs in May, double the 85,000 expected. Headline unemployment remains steady at 4.3%, while CPI inflation climbs toward 3.8%, driven by spiking global energy prices. With labor and inflation both running hot, market expectations have shifted. The Federal Reserve's 2026 easing cycle is likely dead, and a rate hike is back on the table. For policymakers, a wait-and-see approach is no longer a neutral stance. The Fed is now caught in a mathematical trap where inaction leads to easing. This graph shows why. While the nominal target rate is held flat between 3.50 and 3.75%, rising inflation means the real Fed funds rate has dropped from 2.6% to just 0.92%. If inflation continues to rise without a corresponding rate hike, real rates will turn negative. This would mean the Fed is unintentionally loosening monetary policy during an inflation spike. Some major banks still forecast cuts in 2027, but prediction markets are moving toward a more immediate, hawkish reality. Futures markets have already repriced the risk. The probability of a rate hike by December has climbed to 85%, while the chance of a cut has effectively vanished. Incoming Fed Chair Kevin Warsh inherits this environment for his June debut, leading a committee that is more divided than it has been in decades. He also faces direct pressure from the White House to lower rates. This makes proving the Fed's independence his first and most critical test. Warsh is expected to lead with a hawkish hold. This involves keeping rates steady, while stripping the easing bias from the official policy statement, signaling that the next move could just as easily be a hike. The Fed is also expected to publish an upwardly revised dot plot, showing that policymakers now anticipate higher rates for longer. By prioritizing trimmed mean inflation to look past temporary energy spikes, Warsh can maintain a disciplined, rules-based tenure that resists political pressure without rushing into aggressive hikes. As energy prices drive inflation higher, the Federal Reserve's immediate priority has pivoted from lowering rates to aggressively containing a secondary price spike. For the rest of 2026, investors should prepare for tighter financial conditions, sustained pressure on long-duration assets, and a central bank committed to a restrictive policy path.